Rightly or not, gold is widely viewed as an inflation hedge, a reliable measure of protection against purchasing power risk. The precious metal may not be the best option for that purpose, though. Some gold investors fail to consider its volatility as well as its opportunity cost, while others fail to anticipate storage needs and other logistical complexities of gold ownership. For these and other reasons, some view U.S. Treasury bills as a superior safe haven alternative to gold. Both asset classes have their own sets of pros and cons. Here's a look at them. Welcome to the Shakaama Live Show with your host, Shakaama. Like any other investment, gold fluctuates in price. Investors may have to wait long stretches to realize profits, and research shows that the majority of investors enter when gold is near a peak, meaning upside is limited and downside is more likely. Meanwhile, slow but steady treasuries provide less excitement but reliable income, and the longer the gold is held over treasury, the more painful these opportunity costs can become due to sacrificed compound interest. An arguably lesser but no less present worry, some gold investors also must contend with the chore of safely storing their investment by vaulting it at home or acquiring a bank safe deposit box. But in other scenarios, bullion coins that are held for 1 year or longer are classified as collectibles, similar to artwork, rare stamps, or antique furniture. Whether the precious metal is in the form of an American Eagle gold coin, a Canadian gold maple leaf, or a South African Krugerrand, its sale automatically triggers a long-term federal capital gains tax rate of approximately 28%, nearly double the 15% capital gains rate for typical stocks. All of that said, gold has fared better than silver, platinum, and palladium recently, as well as most other precious metals. After hitting almost $1,900 per ounce in 2011, gold bottomed at around $1,188 per ounce last December, and in March climbed to over $1,380 per ounce before leveling off at around $1,218 per ounce today. Gold rise this year is at least partially due to the formidable defense gold and silver presents against the eroding value of paper currency. But in light of this trajectory, many believe gold's future performance is uncertain and favor a shift to treasuries. The biggest draw in buying treasury bonds instead of gold is that the former locks in certain return on investments. Prescient investors who saw fit to buy $10,000 in 30-year treasury bills in 1982 would have pocketed $40,000 when the notes reached maturity with a fixed 10.45% coupon rate. Of course, the days of double-digit percent coupons may be long gone. In January 2014, for example, the U.S. Treasury auctioned at around a 30-year bonds with just 3% coupon. Nonetheless, such bonds could still comprise a key element to any risk-averse portfolio. Depending on your income level, treasury investments are typically more favorable tax-wise, but gold investors may level the capital gains tax playing field by investing in gold exchange-traded funds, ETFs, which are taxed exactly like typical stocks and bond securities. Within the ETF framework, there are 3 distinct ways in which investors may participate. The first, gold mining ETFs, benchmark against mining companies, appealing to investors who are not interested in actual commodity ownership. An example of such an ETF is the Market Vectors Gold Miners ETF, GDX. The next, gold ETF futures, gain exposure to gold through futures contracts. Because these funds hold a combination of contracts and cash, usually parked in treasury bills, they're able to generate interest income to offset expenses. An example of advisor shares Gartman Gold British Pound ETF GGBP. Finally, there are pure play ETFs, which strive to reflect the performance of gold bullion by directly investing in gold trusts. Bullion bars are purchased, stored in banks, vaults, and insured. While pure play ETFs may track the bullion more closely, they have the disadvantage of being taxed more heavily than other versions. An example is PowerShare DB Gold Short ETN, DGZ. In conclusion, knowing when to bow out of gold can be a tough call. As a hedge against inflation and geopolitical risk, gold has ascended to great heights over the past decade due to liberal central bank policies such as the Federal Reserve's recent quantitative easing programs. From here, gold could rally or fall further. No one can predict which way it will go. On the other hand, Treasuries take speculation as well as some excitement out of the mix. Savvy investors should take a sober look at gold versus Treasuries in their portfolios and construct an allocation mix that best suits their temperament and time horizons. As far as Treasuries goes, you want to get the very best entry point into Treasuries. And then you could really make a solid decision on whether Treasuries is the way to go. Thank you for watching the Shakaama Live Show.